All right, let's get right into it. On Wall Street, there's this market phenomenon with a pretty weird name, the taco trade. And no, it has nothing to do with lunch. It's actually a strategy that's come to define a lot of trading over the last few years. So today, we're going to break down exactly what it is, how it just played out during a major global conflict, and most importantly, for anyone who feels like they missed that last big rebound, where traders are expecting it to pop up next.
So, what on earth is a taco trade? Well, it's an acronym, and it stands for Trump Always Chickens Out. The name itself basically describes the whole investment strategy. It's all built on a pattern that's become pretty predictable. The administration makes a really aggressive policy announcement. The market tanks because of it, and then, feeling that heat, the policy gets watered down, delayed, or just reversed altogether.
So here's our game plan. We'll start by properly defining the taco trade. Then we'll look at its biggest test case yet, the recent Iran war ceasefire. After that, we'll get into the nitty-gritty mechanics, identify 3 potential taco events you'll want to watch, and finally, we'll talk about the very real risks and economic costs of all this.
Okay, first things first, where did this whole thing even come from? Because, this wasn't cooked up in some stuffy university classroom. It literally started as a catchy phrase, a meme, really, and morphed into a full-blown market thesis that traders now seriously rely on. The term actually has a pretty specific origin story. It was coined back on May 2nd, 2025, by Robert Armstrong over at the Financial Times. He was the one who pointed out this clear pattern. You get these huge, maximalist threats. We're talking giant tariffs, military ultimatums, and then, almost like clockwork, a de-escalation follows. The whole theory rests on the idea that the administration just can't stomach a down market. The S&P 500 is basically treated like a live, real-time report card on its policies. So traders caught on and started using these policy-driven panics as predictable moments to buy the dip.
Now, as you can probably guess, the administration sees it differently. President Trump has actually talked about this directly. He says it's not chickening out at all. He calls it negotiation. The strategy, from his perspective, is to open with a ridiculous high number to throw everyone off balance and force concessions, then negotiate from that extreme starting point. Which brings us to the most intense and, frankly, the most dangerous test of this theory so far, the 2026 Iran war ceasefire. This was the moment a Wall Street trading strategy slammed right into a real-world military conflict.
Man, things moved so fast here. On February 28th, the war kicked off with these huge strikes on Iran. A little over a month later, on April 5th, President Trump drops this bombshell ultimatum threatening to hit civilian infrastructure like power plants. The world was just waiting. And then, on April 7th, with literally less than 2 hours left on the clock, a temporary 2-week ceasefire is announced. It was the pattern, playing out perfectly on the world stage. Go right to the brink and then pull back.
For Wall Street, this 11th-hour reversal was the ultimate proof of the taco thesis. And for any trader who felt like they missed the bounce, this was the moment that really cemented the idea that this wasn't just a pattern, it was a playbook. Even with the threat of a full-blown war, the playbook held. That made the whole strategy feel incredibly reliable.
So how does this actually work for a trader on the ground? Let's break it down into a really simple, repeatable 4-step cycle. This is what investors have learned to spot and, more importantly, act on.
It really has 4 stages. Step 1, the maximalist threat gets issued. That immediately triggers Step 2, the market sells off, stocks go down, fear goes up. But then comes the pivot point. Step 3, the administration sees the red on the screen and reverses, or at least delays the policy. And that's what sets up the payoff in Step 4. The market rallies, and anyone who bought during the panic gets rewarded.
It's really important to understand just how different this is from traditional economics. The administration style is what you'd call a zero-sum game. The whole idea is that for me to win, you have to lose. You try to cripple the other side before you even sit down at the table. That's a world away from traditional trade theory, which is built on a positive-sum model. The idea that we can make a deal where we both walk away better off.
Okay, so this brings us to the big question, especially if you missed that last cycle. Where could this happen again? What should you be watching for? Well, analysts are already flagging 3 specific deadlines and policy cliffs that are coming up really soon.
Let's start with the one that's right around the corner.
First on the list is the Iran ceasefire itself. Remember, it's just a temporary 2-week pause. It's set to expire in late April, and none of the big problems, like uranium enrichment or who controls the Strait of Hormuz, have been solved. They haven't even been touched. That gives the administration a perfect excuse to issue brand new ultimatums, to kind of get some leverage in the upcoming peace talks. And that, right there, is the classic setup that techro traders are looking for.
The second potential flashpoint is all about a legal deadline. Back in February, the Supreme Court took away the administration's favorite tariff tool, so they quickly pivoted and used a different law, Section 122, to slap on a new global tariff. But, and this is a big but, this new tool has a major catch. It has a hard deadline of July 24th.
And here is that catch, spelled out. The authority under Section 122 is strictly legally limited to 150 days. It can't be extended without Congress passing a new law. This creates what they call a policy cliff, a fixed end date. And it's the perfect setup for another round of threats aimed at trading partners or maybe even at Congress as that July deadline gets closer and closer.
And the third area to keep an eye on is a new set of trade investigations. Since its main tariff weapon is gone, the administration is speeding up investigations under a different rule, Section 301. These are aimed at what it calls unfair trade practices, and they're likely going after major allies, the EU, the UK, Japan. For traders, the key moment will be when the results of those investigations are announced, because that's when you typically get those huge, maximalist tariff numbers designed to scare everyone into a deal.
But look, this isn't just some clever, abstract trading game. This whole cycle of constant uncertainty creates very real consequences and some pretty significant risks that go way beyond just one day's market moves.
Yeah, this data tells a really interesting story. Look at the numbers. Over 15 months, the taco trader barely beat a simple buy and hold investor. The person who really got crushed was the panic trader, the one who sold at the bottom. So what does that tell you? The real value of this taco mindset might not be about making huge gains, but about having the stomach to not lose your shirt by panic selling when things look grim.
And the wider economic costs are just piling up. For actual businesses trying to operate, this creates what you could call paralysis. I mean, how do you plan a supply chain for the next 5 years when you don't know what tariffs will be in 5 months? On the world stage, it creates a serious credibility gap. Allies and enemies alike start to wonder if U.S. threats mean anything anymore. And even though stocks keep bouncing back, the bond market, which is often seen as the smarter money, is flashing some serious warning signs about long-term economic health.
All of this leads to the one final terrifying question. In this new normal we live in, where the market has learned to price in a last-minute reversal, where the taco trade is an actual strategy, what happens on the day the administration doesn't back down? What happens when the bluff finally gets called? That is the billion-dollar risk hanging over this entire paradigm.